Hi, today I'm going to talk about life insurance and estate planning. Life insurance enjoys some of the greatest tax benefits in the code. It can deliver a death benefit, income, and potentially estate tax free. Aside from providing important liquidity for loved ones left behind, there are also tremendous tax advantages to owning it inside of a trust. I've never seen any grantor transfer all his assets to a trust. There's always something left behind in the estate, and those assets can be illiquid and or have federal estate tax consequences. Now, also there may be an existing installment note liability from the trust back to the grantor, and that can be cleaned up using life insurance. And finally, no one knows what the federal exclusion is going to be at the date of death. So that makes life insurance extremely critical to own. Now, the question becomes how to own it. And there are several ways of owning it I want to walk through today. The first is to simply have the grantor make what I'll call non-taxable gifts to the trust. And the trust can own an inexpensive policy called Term for Life. And there's no cash buildup in the policy, and it operates quite efficiently in that regard. Now, also, that Term for Life can also be structured as a second to die policy so that the premiums become even lower because it's based on 2 lives. A second way of structuring premium payments is have the trust pay the premiums, and we do that by having the grantor gift assets into the trust. Income producing assets are transferred into the trust, and life insurance is purchased inside the trust, and the income producing assets begin paying premiums. A third way of structuring premiums, or paying premiums I should say, is to have a bank step in and do that. Now, that's very popular with affluent individuals who have existing investments that are either illiquid or giving him too high of a return. So a bank will step in and pay the premiums in cash value life insurance, I should say. And I will also want to point out banks love life insurance because there is no unknowns in terms of value. So, and we position a high early cash value policy inside the trust, and as I mentioned, the bank takes a collateral position in it, and the trust and the bank begins paying premiums. Now, it's not uncommon for the grantor to have to post side collateral in the early years in this scenario. Now, it's also possible we can obtain life insurance with using premium financing with no side collateral on the part of the grantor. I'll have to explain that when we meet. Now, what happens if the grantor is uninsurable? We look to insure instead his children, and in so doing, get a dramatic discount for doing so. I can't explain it here. It's a little too complex, and I will say that the IRS lost a major case in this recently, and it's opened up the doors to doing this, and it's got to be done properly, obviously. Thank you for listening, and I will be back with you with an additional planning video in the near future. Thank you. Bye-bye.